If you wanted volatility and NVIDIA earnings were a massive disappointment, well, look no further than this week's labor report. Mondays, of course, a holiday, markets are closed, but then we go into JOLTS, ADP non-farm, the jobless claims, hourly earnings, government non-farm, and the official unemployment rate. It's an absolutely loaded lineup this week that you better believe the Fed is watching closely, therefore, the market is watching closely. So welcome to the Trade Brigade Weekend Show, where we'll build a trade plan, but also we'll look through those labor-specific charts that really speak directly to recession probabilities. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame chart now that the August bars have officially closed out. What do we see here from a candle structure and location perspective? Well, structurally, it's a green hammer-esque style bar. And depending on who you talk to, they may consider this a bearish hanging man style candle. It's happening at the top of the move. It's got to be bearish. It's going to indicate a reversal. At the Trade Brigade, we do not subscribe to that theory. We take every single bar, every single candle at face value. So how is this produced? Well, of course, to offer the lower wick, there's some downside panic. No doubt about that. We know it's the yen carry trade, and on August 5th, there's that large gap down. But it's a lower wick for a reason. We did not close down here. We can all see that the buyers stepped up off the lows of the monthly range, and they were able to push prices higher. Now, higher to the opening print, absolutely, but because this is a green-bodied bar, we can also see that there was range expansion in the upward direction. There was a pretty strong close basically at the highs of the entire August range. So that's bullish in my book. This is not at all a bearish indication structurally. What about location? I mean, on the bar-to-bar count, we've got ourselves, for all intents and purposes, an equal high within spitting distance to the all-time high. If we're considering the lows, absolutely, this is a lower low. That is technically bearish on the downside, but once again, this is a very strong monthly close. Why is that close so important? Well, put yourself in the shoes of a seller. In July, you print an inverted hammer, where in the upper wick, we know sellers are stepping up, and in August, we break down through the low of that bar. Totally reasonable for a pullback to unfold. If you're a seller underneath July's low, where do you want to see August close? Probably underneath July. You want to see progress in the downward direction. Okay, we didn't close down there. What's the next best place? Probably underneath the opening print of July. Did we close underneath that? Absolutely not. What about the settlement of July's price? Absolutely not. Did we close, meaningfully away from the upper wick? No, we did not. This is a very strong close. So on the location bar-to-bar count, even though we have a lower low, there's really nothing bearish to say about the current stance of this monthly chart. Even zoom out. Consider the higher, clustered time frame trend. This to this is a monthly higher low. This is a soft higher low. On the weekly time frame chart, there was no lower high in that April pullback. During this August pullback, did we find a weekly lower high? That was my concern. We made some videos about that. That was a reasonable threat. There was no weekly lower high. So this is another soft higher low, meaning that on the monthly time frame chart, as long as price is above 480, the previous all-time high back here, I really would not have any major concerns about a trend reversal. How many times in early August did we also talk about, on the monthly time frame specifically, that large downdrafts in the market only happen when the monthly trend changes to down? You can see we get a lower high, and then things become more painful in 2022. If we look back at the Great Financial Crisis, zooming way back, you'll notice that we have sort of equal high, considered a double top, whatever. Here's a monthly lower high. Here is a lower low. We're in a downtrend. That's when things get painful. Also make note, in this particular example, where we're at relative to the monthly 50 SMA. Let's go back to the dot-com bubble bursting. Notice a similar pattern. Here's a double top. Here's a lower high. From here to here, you get lower lows. You're in a monthly downtrend. Things get more painful. You're underneath the monthly 50 SMA. Let's go back to the present day. How does this chart look relative to those previous trends we were just talking about? Much, much, much stronger. Not even close to the 50 SMA. No offering of an equal high on the monthly. No offering of a lower high on the monthly. The trend is up. There's plenty of room for a pullback. This is looking bullish, in my opinion, on the higher time frame 90,000 foot view. So if that's the case, where could we possibly be headed into blue sky territories? Let's come out with the Fibonacci extensions on the monthly bull flag from point A up to point B. Pullback is C here. Notice that the 61.8, a little bit arbitrary in my opinion, but it did act as support. It basically marks the exact low of the August pullback, right? And then look at this extension. I think this is interesting because this 610 right here is also confluence from what I would consider as much more of a weekly bull flag. If I do something that looks like this, from point A to point B, pullback is C. It's the red bar on the monthly here for April, right? That's confluence at 610. Now, I'm not arguing that we go here in the month of September. I'm not even arguing that we go there in October, but it's something to be aiming at as and if we continue into blue sky territories. I like what I'm seeing on the higher time frames. No reason to panic just yet. Let's bring it on down to a weekly time frame chart. Let's start to get granular here. What do we see? Candle structure and location as always. So almost a rinse and repeat, honestly, of the monthly time frame. We've got a little bit of a, air quotes, hanging man style candle. Oh no. In my view, it's the same concept. You have buyers stepping up off the lows. You made an equal low. You made an equal high for all intents and purposes. We know the daily is stuck in a long-standing balance. Not much to really talk about there. If the sellers were going to make a stand, why wouldn't we have at least closed down here near the bottom end of the weekly balance? On the weekly chart, you've got an equal high now. I would argue that any higher lows that form are really constructive for a continued uptrend walking forward. So where might we want to be on the lookout? Well, the 38.2 Fibonacci is at 543. The other interesting thing, as we know, is coming in with the weekly anchored VWAPs, you get the same cluster at that exact level. 543.60, 544.50, 545. What's also interesting about this, I'm going to change drawing sets real quickly. This is the gap close, which we'll see on the daily time frame chart in just a moment. That also strikes me as really strong confluence for a weekly pullback. I'm going to go back to the clean set here, and we are going to throw on the volume profile just to be congruent in our analysis as always. What I want to point out here is just that the volume profile is also supportive of that same exact area. If I zoom in, your high volume node is right there at 543.50, 544, 545, that general zone on a weekly perspective, even if we break down from the daily balance range, could offer a higher low, and I would maintain a bullish stance coming from the equal high here. For anybody calling for a weekly double top, just to get this one out of the way, we all know that double tops trigger when you make a lower low underneath the neckline. So unless you're calling for a move all the way down underneath 509, 50, 510 in this upcoming week's worth of trade, it's not going to be a weekly downtrend. Let's get granular and move on down to the daily time frame chart. Let's keep it simple here because the balance range really doesn't offer much to talk about. First and foremost, weekly expected move. Let's talk about it, and then we'll keep this show rocking right along. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 571.29, implying a higher high blue sky breakout. That, of course, is bullish. If we're contained by the lower bound, the number's at 556 on the money. That's not, it's not a strong breakdown from the balance range in here. It is underneath the key level at 557, and we'll see that on the hourly in just a second, but it's really not detrimental to the trend. We know that, any higher lows can even persist on the daily time frame chart. Here on the gap close we were just referencing, it's 544.85 if you want to get precise here on the daily, this gap close from back here. Even if you were to pull back, again, let's get crazy here. The market reverses. Oh no, the balance is not going to break in the upward direction. You could even find a higher low here off of 553, the prior top end of this move from here. Remember that this higher high is instantly what classified the daily as being in an uptrend. So it's been a very stubborn range. There's not much going on here, but I would really just lean into the most recent sequence we had. Look at the lower wick breaking underneath 557. Was it successful? Absolutely not. Look at the follow-up day on Thursday. We looked over the top end of the range and closed weak again at the bottom end of the range. So if anything, that should have set up, coming into Friday, a pretty decent opportunity for sellers to make something happen on an intraday lower high underneath 557. No signs of that by any stretch of the imagination. Longer lower wick closed at the highs, even over the top end of the balance here at 562.50. So the all-time high in spitting distance, we have 565.25. There's nothing really bearish to say here about the SPY daily. The only concern that I could sort of maybe speculate about would be a look above and fail on the balance, right? You get some kind of daily breakout here. It makes a new all-time high. Then it comes into range. I don't know that I would be bearish on the move in range. I would be bearish on a lower high set underneath 562.50 on the daily or some sort of breakdown underneath 557 if this breakout fails. But we're not there yet. We don't know if this breakout is going to fail. So therefore, I don't even think it's worth speculating about. Let's take it on down to the hourly time frame chart and continue to get granular. Once again, this is Wednesday right here. This is pretty bearish acceptance near the lows. On Thursday, here's a look above and fail on the range. It goes all the way to target right at the bottom. And then even intraday on Friday, you open near the highs. You reject the top end of the balance. That's pretty like status quo balanced trade, right? Fade off the highs, move to the lows. Okay, if stronger sellers were going to step up, why was there no like bear flag consolidation into the afternoon, setting up some sort of trade for Tuesday on a move that looks like this underneath 557? It just simply didn't take place. You could call it end of the month window dressing. I'm not a firm believer in any of that anyhow, but I mean, maybe that's what's taking place into the close on Friday. But again, the trade brigade, here we take everything at face value. If you start to get too fancy, too cute with, oh my God, I think I know better than the market, that's where you get hurt. So at face value, this is starting to look more so like a successful breakout, of the balance range. And any sort of acceptance over 562.50 becomes very, very clear that the all-time high is the minimum target, if not follow through into blue sky territories. Weekly cup and handle target, 570. The upper bound of the weekly expected move, 571.29, right? These things become interesting to me. Now, noting that we do have many catalysts in the labor department this week, I would not be shocked if the market comes into range, consolidates here. There's really nothing to say about the market. There's nothing constructive in between 562.50 and 557. Be my guest if you want to play the ping pong. Do whatever you want to do. But I would not be shocked in the slightest this week if with some of these catalysts, if the market does want to get bearish and move into the range and break the range low, I would not say something like, oh no, we're extended through the lower bound of the weekly expected move. It's not possible that the market could even think twice about moving lower. No. With catalysts, it's very reasonable that you could get into 553. That's like at minimum, right? Whenever we're dealing with balance ranges, we typically look for a range double. Into blue sky territories, that brings you closer to 566.50. To the downside, if we're just, again, spitballing it, at minimum, we're talking about 553, if not further, to test something like the daily 50 SMA. The top end of the gap is reasonable at 549, and then the closure of the gap that we've already described at 544.85. My apologies. Weekly higher low at that zone. So everything I can see, once again, points to the bulls being in control here near the highs. And we'll see this throughout the supporting evidence as well. So I'll give you some initial pathing here. What I would be looking for early on Tuesday, consolidation up here looks great. Brigade bolts into blue sky territories. We're trading it long. There's no reason to be a bear up here. If this fails, and I will bring out the red crayon for this, I would start looking for shorts on lower highs here, underneath 562.50. The first pullback, I'll maybe use blue for this, something that looks like this after making a new all-time high, you might entertain more of a like Brigade bolts daily, right? If this is the range, maybe you get sort of break, higher, low, above, then continuation. That's a possibility. So the reason I use the red crayon very intentionally underneath 562.50 is to illustrate that I want price back inside of this range to classify this as a failed breakout if we're going to start looking for shorts. And of course, the first target would just be the bottom end of the range, and then possibly any lower highs here start to get even more dangerous. 549, 544.85. I want to be clear that I'm open-minded to trading these downside outcomes. I'm just not seeing the evidence that they're higher probability as we come into the upcoming week, right? If there's some sort of opening drive to the downside that puts us in range, neutral, I don't even know why I'm using a red crayon. We should use white for this. This is neutral, and we'll just take it, again, at face value. If the market does decide to break the balance range, it's the same exact concept here as it is over here. If the market gives a strong opening drive to the upside, we should give the green crayon some love as well, something that looks like this, bullish also. I would really start to favor, like my primary outcomes for this week would probably be rank ordered as follows. Number 1 in white, number 2 in blue. Let's see if we can get all the colors here. Absolutely love it. This would be number 3, opening drive to the upside, higher low over this. The reason for that is just because I think that the market's going to be tense around the initial claims that are going to be coming out on Wednesday. So that Tuesday session might leave a little bit to be desired. I think that it's very reasonable the market might consolidate here before trying to make some sort of move in anticipation of the reports, right? So that's what I'm seeing on the hourly. Let's take a quick look at the intraday anchored VWAPs. We're above the entire cluster. This has continued to act as support. This is really what kicked off the daily trend reversal after the August 5th panic. You'll notice that we're over this, which was the bearish engulfer from now 2 weeks ago, and even the Thursday gap up I mean, just over it all as of Friday's close. That, of course, is bullish. If you come in here with the Fibonacci's from this perspective, still well above, I mean, obviously, well above the 38.2, but it's confluence with the bottom end of the balance. So for all intents and purposes, the sellers have not made any meaningful progress through the duration of last week's choppy range that was produced. Let's move on over to the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Pretty informative stuff. What we want to focus on is on Thursday, when intraday on the hourly, just a moment ago, right? We were talking about how Thursday looked above and then closed pretty weak down here. It set up an opportunity on Friday for possible bearish follow-through. Well, at the exchange level, was Thursday really that bearish from the top end of the range to the bottom end of the range? The answer is no, and the market internals suggest that, right? So here, volume inflows. Here, advanced decline line was in or near trend higher zone for a duration of the day, and the cumulative build out of the tick was fairly substantial, up around 3,600, 5,000 is really where we draw the line, but it's not like we had a bearish reversal into the close. I would argue that shorts who got overly aggressive into this very minor bear flag consolidation as the bell was approaching, they were the fuel to the fire to sort of squeeze out into the afternoon. Once there was no follow through underneath the bottom end of the range, 5610 we've been using in the ES futures, they totally pinched out, not wanting to hold stuff over the weekend. That's, obviously a little bit speculative, but that makes sense to me in terms of describing what types of participants we have in this market. We really don't have stronger shorts. We have weak-handed shorts who squeezed out, and buyers possibly preparing for some sort of breakout trade into blue sky territories. Those are your market internals. Let's take a brief glance at the market profile. If you're not familiar with this sort of chart style, check out the video tutorial in the top right-hand corner. I think that what we can read into here is the spike, right? M period spike. So on the Tuesday open, we'll have spike rules in play. If we open in the spike, we're looking for neutral outcomes. If we open on a gap up over the spike, we're looking for this market to auction higher, right? Because what that would tell us is the market only stopped here because the bell rang on Friday's session. It's, buyers were not done buying and sellers are still nowhere to be found. So a gap up would likely indicate some sort of gap and go, in my view, up into blue sky territories. An open underneath the base of the spike keeps us inside of the daily/hourly balance range, and therefore I would really have to be more neutral in here. That's that white crayon outcome that we were just drawing a moment ago. You'll notice that the value area is slightly lower, and the point of control certainly did not migrate higher with price on that Friday session. So this could indicate two things. If longs are holding positions, they were not willing to execute those new positions up here, and this was really driven by short squeeze, which is what we just referenced on the internals dashboard, so that checks out. If longs were building positions, they were building them down here, not up here. So once again, what does that mean? If the market is going to break down, you would likely have to take out something like the Thursday-Friday low, 55.95, and then the longs would say, okay, we're going to stop out respectfully and we'll look for a stronger daily high or low opportunity, perhaps on the gap close. So I'm not seeing anything here, even on the market profile, that's overly indicative of stronger sellers starting to get active. Let's move on over to the QQQ, and we'll just give this a little reset. We'll jump on up to the monthly time frame chart. We'll do a quick monthly, just because it's similar yet different. It's not nearly as high to the equal high as the previous month of July, and we know that there's some discrepancies, as we get lower through the time frames as well. But you still are getting a hammer-esque style bar. We looked underneath July's low. There was no close underneath. We did not close underneath the settlement, but we did close underneath the opening print. And on the bar-to-bar count, we do also preserve a little bit more of a bearish indication with a lower high. In the grand scheme of things, though, you still have lows, higher lows, soft higher lows, maybe soft higher lows. You could call them equal lows. Doesn't really matter. I would not even say anything bearish about the overall trend here on the monthly time frame. Are things getting volatile? Are they slowing down? Yes, but not to the point where I would say, look out below, the floor is going to fall out, and oh my goodness, we're going to see a 50% retracement out of the NASDAQ. And when I say 50%, I'm talking about 50% decline from the current price, not 50% of this move. So you get the idea. Similar concepts as the S&P monthly, with a little bit more of a bearish stance on that lower high. We can see something similar on the weekly time frame. We've been talking about this possible threat of a weekly lower high, so we're not totally out of the woods here. You do have this bottom end of the 2-week balance acting as potential resistance. The market tried to move lower, and the sort of competition of the time frames right now is just understanding that, yes, weekly lower high, but is it possible that you could set some sort of higher low and reverse this higher? Yes. I think that would be more of a back pocket situation. One of the concerns I would have for this market, right, and this is something you can carry forward, we've been talking about this for weeks now, is if you're looking for longs, you're in the S&P. If you're looking for shorts, you're in the QQQ. What I would carry forward, though, is if the S&P 500 makes a new all-time high and is trying to accept in blue sky territories, and the QQQ is notably divergent, and by that I just mean it's not making a new swing high on the weekly over this previous pivot. To give you a number, that's 485.50 roughly. If the Qs do not make a new swing high here and continue to consolidate or even pull back as the S&P is breaking out to blue sky territories, I would be mindful of that divergence and really manage your expectations in the blue sky territories for the S&P. It doesn't mean short the S&P 500. It just means manage long side expectations, right? Let's come in here with the Fibonacci's. Let's take a look to see where a higher low pullback would be sort of validated. On the weekly, we're over it in the lower wick of the weekly bar. Just FYI, candle structure and location is sort of bullish-ish here, right? Hammer candle, yes. Long lower wick closed inside the previous weekly range. That's a positive, but you do have the bar-to-bar lower high as well as lower low happening over the 38.2. Another feather in the cap for the bulls. If we bring out the weekly anchored view apps on the NASDAQ, supporting over the cluster, another feather in the cap for the bulls. And if we take a look at the volume profile, what we'll see is yet again another feather in the cap for the bulls. If we just drop this to a 6-month chart and zoom in a little bit, you're sort of at or trying to support that lower wick off of sort of what I would consider a line in the sand from a volume profile perspective. You don't want a close underneath this node, otherwise you get a low volume rotation, likely towards that 450. So we're definitely a bit more cautious in the NASDAQ. And if this chart decides to break down, so be it. I will certainly lean into the fact that this is a lower high, and we'll be thinking about shorts here, and we'll just let the S&P do its thing. We'll, maybe avoid longs in it, but we're not shorting the S&P. We're shorting the NASDAQ on its relative weakness, clearly described and illustrated by the weekly time frame chart. Let's bring it down to the daily. Let's get granular here. Let's see what's going on with the weekly expected move first. So the top end of this move is up around 485.37 if contained. That's mostly an equal high to the Thursday bearish engulfer of now 2 weeks ago. And if we're contained by the low, it's a 467.22 move to the top end of the gap, equal low to what we had last week. I would really argue that this keeps us more so in a balance here than much more of a trend, right? Equal highs, equal lows. The pullback here has been a little bit more directional versus the S&P, which is certainly more sideways, but we are supporting over the top of the gap. Same indications on the Thursday-Friday interaction. On Thursday, sellers sort of reject exactly where they should have, right? This previous pivot here and here acted as support or just the end of the bearish engulfer on the Thursday of 2 weeks ago. Sellers stepped up there on Thursday this week and closed back down towards the lows. Now, Friday's just an inside bar, but there was some intraday bearish pressure. Where do we close? Back towards the highs and actually over this inflection point at 475. So I would really keep it simple on the QQQ NASDAQ. If you're over 475, probably bullish, looking at least for the equal high, if not follow through to test the gap overhead. That would be great if the S&P 500 is trying to make a break for blue sky territories. If you reject this 475, 477, and come back down here, now we have some concerns. I would at least be thinking about gap close. That's a simple one. But really a deeper move into the daily line in the sand for a higher low at 459.50. I would still make the argument that from here up to here, you have the opportunity for a higher low. You have highs, maybe some lower highs. We can see this on the hourly, as a matter of fact. Let's just go there now. On the hourly, right, you have highs, lower highs, clusters of lower highs, lows, clusters of lower lows. So you've got an hourly downtrend, meaning that the daily higher low is going to be solid at this point. It's not a soft higher low. We've achieved an hourly downtrend. If we were to get here, I would really want to see the hourly trend reverse and try to make a move back in the upward direction to confirm the line in the sand daily higher low. That's if we stay below 475, bearish consolidation, break through the gap or something like that and test this. This is where we want to see those daily buyers step up if the chart's going to remain more constructive on the daily or higher, right? Weekly higher low as well. On the hourly chart, some things to make note of. This is almost a double balance, right? You've got balance 1 and balance 2 here. These are relatively equal lows, relatively equal highs. If you break out over 477, once again, the target should be the top end of this previous range, 483. And then from there, any higher lows want to persist over 477, then possibly threatening the break in the upward direction to close that gap overhead. If we had to get involved with some pathing, it might look something like this. This is neutral. This Brigade bolt here is bullish. We would then want to see subsequent higher lows hold. Equal high breakouts. We'll bring out the green crayon for this because this is new swing highs. That would be bullish. Test the bottom of the gap, possibly close it. That's 488.50, closes 493.10. if we're going to be bearish, right? We continue to look at this as sort of neutral, but okay, we slip the lows. Let's bring out the red crayon. Lower high here. And then I would want to try, again, based on the daily conversation we just had, I would want to try flipping to bullish here, looking to see whether or not the hourly trend could reverse off of this line in the sand. One more time, just for clarity's sake, 459.50. If the market takes this path out of the QQQ, the downside path I'm referring to, let's use blue, here, I would dial back long-sided expectations in the S&P, and I would focus mostly on where I can find and spot and participate on this lower high underneath the lows of last week, 468.35, the top end of the gap, targeting something like 459.50. Pretty clear about that, right? If the market is breaking out in the NASDAQ up and over this set of highs, Brigade bolting over 477, I would say, great, that's awesome that the NASDAQ's helping. I would still go over to the S&P and I would focus on trying longs over there, not in the NASDAQ by itself. Let's take a look at the intraday intraday anchored view apps, rather, not inverted hammers, but anchored view apps, kind of clustered up at this area. So I think it just really reinforces the idea that range here that Brigade bolts out of it would be constructive recapturing those. If we're underneath, slightly more bearish consolidation, looking to participate on that lower high. If we bring out the Fibonacci's, because this is of course different from the S&P, from here to here, we did technically close the daily bar, the last hourly bar here, over the 61.8. If bears were really going to make a stand, this should have stuck lower high underneath, would have been looking for bearish breakdowns into the afternoon, setting up more of an opportunity early in the coming weeks worth of trade for something that closes the gap and breaks down. Simply didn't take place. So once again, are the bears really making a huge amount of progress? No. To me, this looks like mild consolidation, a reasonable pullback after a monster move off of the lows. Like, let's not forget that this is a huge move off of the lows, and a little bit of digestion via time is totally reasonable here. Let's jump on over to the NASDAQ market internal, see what's going on from this perspective. A little bit more bearish, just in the sense that on the Thursday session, you did have inflows, but here things were a little bit more aggressive to the downside. That Wednesday session, we talked about that in the midweek market update. So really, at this point, mostly similar to the S&P, where I would not say you have stronger sellers stepping up on Thursday, in particular here, and here, and even on Friday, as we got this sort of V-shaped recovery off the lows, this never really got aggressively bearish out of the cumulative build. It's not like volume flows were out. Advanced decline line actually closes positive. So nothing horrendous to say at the exchange level. Let's bring it on over to the NASDAQ market profile and see what other type of nuances we can pick up over here. What I would really focus on is just the poor highs. Massive poor high on Thursday, massive poor high on the Friday session, meaning that if we need some repair to that structure, it would not be unreasonable to break through those when you're testing them from below. So an open in range that tests Friday's high, I would look instantly to Thursday's high, and then if we could test that 19.7, we know we're going to the next step at 19.8. That's the next target overhead out of the NQ futures, a full 100 points in the upward direction. So that's really what I've got for you out of the market profile, pointing out these deficiencies here in need of repair, and technically that is a bullish indication. Let's jump on over to the Russell now and see what's going on with the IWM, starting on something like, let's reset this so the hourly anchored view apps are gone. We'll go here, monthly chart. Thank you guys for bearing with me as I'm flipping through charts. I really appreciate that. There's huge progress here, and we really talked about this in the month of July, but I think that the August move is really a testament to small caps trying to get in gear. And if we think about what small caps represent, right, we've talked about this a million times by now, the lack of breakdown back into this range here, it's really just a retest to the top end. You could start to consider this like a monthly Brigade bolt. It sort of would suggest that market participants are not overly concerned with the R word, recession, right? If we thought recession was on the horizon, people generally do not flock to the risky asset class like small caps. Typically, they require lower rates, they're riskier, they're not always profitable. It's not where you want to be. So the fact that the market had closed all the way back up here after this retracement and staying outside of this range strikes me as constructive in the upward direction. And I also want to harp a little bit on something like the KRE on the monthly time frame, where again, we had some concerns, and we talked about this on weeklies for the last little bit, but when this breakout was taking place, as a matter of fact, I know we're traversing timeframes, we're a little bit all over the place, but it's okay. This was a concern, right? This move underneath, and the August bar just proves that participants are like, okay, there was some panic, of course, on that August 5th, But was it meaningful? Are there reevaluations of whether or not regionals are going to sustain themselves through this cutting cycle? No. The move higher makes sense to me. And if the recession thesis was really going to be at the forefront, probably would have seen acceptance underneath 53, a big failed breakout, and oh my goodness, things kind of get nasty and get worse from here. It doesn't mean that the market can't get underneath 53 at some point in the future. Sure, markets can always do whatever they want to do. But at face value, as we approach the upcoming week, as we really head towards September, as we're trying to make sense of all the data points, this is really not suggestive of a big, deep, dark, dirty recession being imminent and on the horizon. Now, watch, I'm going to say that, and on through the duration of the week, and namely on Friday, the full labor report's going to take that for a spin and make me eat my words. But at this point, trading the chart in front of us, it's got to be more bullish than bearish. So back to the IWM monthly. This is a weekly now. Sorry. We're trading fine. We're near this high. For the most part, the next weekly high or low needs to stay outside of the micro range. Remember, we had a big range. We had a micro range. As long as we're over the top of the micro range from here on out, I would say we are constructive out of smalls. That's staying over 210. So you can call it the hanging man, call it whatever you want. It's still technically a hammer candle in my book. Higher low on the bar to bar count, higher high as well, excepting inside of this range. Really, really clear on the daily chart. But before we go there, let's just be congruent, right? From the low up to this most recent high, this lines up. As long as we're over that 210, 212 is the 38.2, bullish consolidation, looking for follow through over time. Again, avoiding the recession concerns. Let's bring out the anchored VWAPs out of small caps here. Over them all, right? The entire cluster, the band is underneath us. We're all set, and we know that we'll keep this on a higher time frame or higher view. But let's bring up where is it? We want the volume profile, right? We're staying outside of and above this high volume node underneath. The more time we could spend like rotating through this and trying to accept in this area in here, the more bullish that would become, right? If we can build out this high volume node, great. That's showing price acceptance. The next target is really up here, closer to like 245, right? That's basically all-time highs out of small caps. Now let's get down to the daily time frame chart. Let's get a little bit more actionable in terms of what we could be thinking about this upcoming week. Really not much to talk about last week other than, right, just the biggest takeaway is the fact that this support came in, keeping price inside of this previous range. If the bears were going to make something happen and totally flip the script, oh my goodness, recession, bearish, market crash, end of the world, would have required something that did this. Now all of a sudden you're dealing with highs, lower highs here, would have been detrimental underneath 215. Not the case. You can see that we're just inside of this range, kind of consolidating and chopping around. The daily structure is not all that insightful. I would just tend to say over 219, looking for consolidation. Any new swing highs are bullish for the S&P 500 in particular, not the NASDAQ, right? If we were to break underneath 215, okay, second thoughts about the S&P 500. 215 is basically the lower edge of the weekly expected move, and the top end of this balance here at 225.25 is basically the upper edge of the weekly expected move, just to say those out loud. Let's get on down to the hourly time frame chart. Once again, not very constructive here, or any major commentary. You could make the argument that if the sellers were going to make something happen, well, here you go. Here's your opportunity on Friday. You opened over 219. Stronger sellers should have, in theory, produced a lower high underneath. You can see rejections, then acting as support on the open here, support into the close. If stronger sellers were here and there were going to be more concerns out of small caps, a 219 lower high would have been more damaging, simply didn't take place, really more neutral through this range. Once again, this is bullish consolidation looking for this, helping the S&P 500. If we're down here, it's not the end of the world, but this starts to become more painful. 215 is that key indication. We could just quickly check in on the intraday anchored VWAPs. You're above the entire cluster, and we could even come in here with the Fibonacci's off the low of this move up to the top. Never really getting much of a strong amount of price acceptance under the 61.8, which would have just implied a retest of 215 in the first place, not a break of it per se. But the more time we spend over the 38.2, which happens to be 219, the better it looks for a possible Brigade bolt into the highs instead of the lows. Once again, a bit more bullish here on small caps versus bearish. Let's jump on over to our Russell internals. Rinse and repeat of everything we've been saying so far. Thursday, Friday, not the end of the world, closes back strong, and cumulative ticks got a little bit of something going on there. Just the lack of move higher out of the open for that. But for the most part, not detrimental, not the end of the world. All the commentary still stands, even with this context. We could take a look at the market profile of the Russell. and see what else we can learn. So of course, inside bar, as we had already noted, notice that the value area is, inside for all intents and purposes, but the point of control does migrate higher. So there's an attempt to move prices higher here, and in that view, once again, I would probably maintain more of that bullish than bearish stance, and I would start to become more concerned when and if there is a move underneath 2180. 2180 is the level that we've been using on the downside, really way down over yonder. So not a threat currently, and that is going to do it for the Rusty Russell. Back on over to the platform, let's take a look through the sectors now. For our S&P, let's look at more supporting evidence. What do we see out of the weekly performance? XLF leads the pack. Financials, second heaviest weight sector, definitely risk on. That is helpful as the market's breaking out, or attempting to on Friday, break out of this balance range over here. Financials are also very much so responsible for the sideways activity versus the QQQ, which had more downside consolidation. Not like the end of the world breakdown, but downside consolidation. So the diversity coming from financials is helping the case here. Financials, as we'll see in just a moment, are making brand new all-time highs. XLI, it's medium weight. It's not necessarily risk on, risk off, but fine, towards the top of the list. Materials, very lightweight, also performing quite well. Healthcare, a little bit more D for defensive, up over 1% by about 3 basis points there. It's heavyweight, but it is technically D for defensive. I wouldn't say posture is a huge concern here. At the bottom end of the barrel, it is the SMH. The semiconductors down 1.63%, followed by the XLK tech sector, 1.53%, and then communications. What have we been talking about, right? Short NASDAQ, long S&P, and it's because of this diversity up here. XLF and really the XLV keeping this sideways in a range as both of those sectors are making new highs. So posture does not strike me as being unreasonable, but it goes one step further than that. If the XLF needs a break, if it's going to pull back and say, you know what, we made new highs, it's time to cool off, what now has the opportunity to possibly take its place? It's going to be these laggards of the previous week. If they're like, okay, we sold semis enough last week, we know NVIDIA earnings, like the numbers were fine, the expectations weren't really great, but let's just start buying semis again. The AI boom 3.0 is around the corner, whatever. Whatever the reasoning might be, the semiconductors and the tech sector, if they catch a bid this upcoming week, would allow for pullback in the XLF without destroying the S&P 500, and I think watching that rotation is going to be very important. Let's check in on the structural charts, see what's going on. XLF up and away. Not much to say here. How can you be bearish the broad market with financials making new all-time highs? M&A activity, right? Goldman, JP Morgan, all those guys in the last sequence of earnings reported that business is on fire, basically. Never been better. So looking good over here in the XLF, bullish for the S&P. XLI, same comment, new highs. Let's take a look at materials, trying to break out finally for this long-standing balance range over here. It's been in range for almost all year. New highs are going to be helpful. Now, it's because it's a pivot high. Overall, we know the XLB is really lightweight. It's not all that meaningful. XLV, healthcare, grinding to new highs. Once again, how can you be bearish on the market, S&P specific, when these charts look like this? Plenty of room, plenty of opportunity for higher lows, right? XLU, D for defensive, most bond-like sector, but again, higher lows here, it's fine. Downward, upward pressure is upward pressure, and downward pressure is downward pressure. So far, so good. XLP, bullish consolidation near the all-time highs. If you can break out through this, great, bullish pressure. Let's take a look at semiconductors. How bad was it out there? Oh my God, it was down 1.63%. It's really still just a mild pullback in the context of this move off of the lows. I mean, classic pattern would just be bull flag. Ideally, the next phase of this is getting some sort of move up and over these swing highs. Like I would want to see price activity over 250, 225, just for round number's sake. If we could get over that, great. That's really going to fuel the next leg higher, I believe, out of the S&P. I would start to have more concerns out of the SMH, just simply noting that, yes, let's be mindful of the structure here, right? Lower high, rejecting possibly the neckline of the double top from back here. Let's not forget about that. Let's not throw all caution to the wind. But I would, and I think that the counter pattern to this, just to be clear here and offer clarity, this is what we're hopeful of if we're trying to remain bullish, the inverted head and shoulders, the clearance of this pivot high. That's the whole reason why I just said that spiel. But if you were to drop underneath the left shoulder with a lower high here, okay, whoa, S&P 500, not good, dialing back longs there, and probably actively looking for shorts in the NASDAQ, right? So that's the take out of semis. Similar story over here in the XLK, but it's honestly better. It's better than the semiconductors. Why? It's this line right here. Your right shoulder is above the top of the left shoulder, right? So all set. As long as this is over 218, really not much bearish to say. And I can just have the same comments as the index with the Friday inside day after a sort of rejection on Thursday and closing weak at the lows. If stronger sellers were here, why was there no runaway on Thursday? Like, look at the thin structure retracement, right? It's there. It's very possible that under 218, there's a snappy move into 212. We'll look out for it as a possible trade, but it just didn't happen. So if we could stay over 218, it's bullish for the broad market, in my opinion. Let's move on over to the XLC, pressuring the all-time highs. Plenty of room for a higher low pullback. Bullish for the broad market. XLY, similar position to our other charts here. I would argue once again that the inverted head and shoulders is nice and bullish, namely over 185.15, the top end of these prior highs, really this entire range from back here. Nice hold into the end of last week. XLE is a nothing burger. It's been in this range. We've been talking about it in the pre-market prep. Not much to comment on over there. And the real estate sector, of course, trying to make new highs under the assumption that rate cuts are in the pipeline. Not a shocker over here. Let's jump on into the ratio grid and see how these things are performing relative to the S&P 500. The XLK needs to get on its horse. If the S&P is going to remain resilient and strong, ideally this makes a move up towards the 50 SMA, at least for an equal high. I do like the fact that as financials broke to a new all-time high, you're getting a move in the ratio to mirror that as well. Bullish there. This is okay and really more so neutral. We don't want massive outperformance, but we don't want underperformance per se. Discretionary still has some work to do. Trying the higher low, but still don't ignore this sort of lower high. A trendline break there would be super helpful for the bulls into the upcoming week's worth of trade, some sort of recapture of the 50 SMA. The risk off sectors, namely the XLP, haven't really done much, more so stable and sideways. Utilities, more so stable and sideways. Not overly concerned with that, especially as we start to look at more supporting evidence. This is actually going to go in the opposite direction for just a brief moment, but risk appetite charts are still bullish, right? We'll get to that. Here's the SHY over the XLK. You can see that we're trying to make a recovery effort over that 2.6, excuse me. If this can break out as a bull flag, once again, that would be a helpful factor for the broad market this week. The XLU XLK, not looking so hot, still rolling over here, so not completely sold. If we take a look at the XLY XLP, trying to stay in range, this higher low needs to hold over 223 if we're going to remain constructive. Any move to an equal low, whoa, second guessing some things in the S&P 500, that would not be a good sign. Semiconductors versus healthcare. We know healthcare is grinding up towards new all-time highs and semis are kind of lagging, so not shocked to see this move lower here. And we talked about the structural charts already, but ideally this would find some sort of higher low if the broad market is trying to make some sort of new all-time high into the upcoming week's worth of trade. If we just maximize the yen over here, and let's go to a very quick candle chart, just to point it out, right, we are setting some sort of attempt at a double bottom. I would not classify it as a double bottom until you're over the neckline here at 149. Generally speaking, what I'm getting at is we never made a new swing low. There was never that second wave of pressure into the yen carry trade to panic people over in NVIDIA. That's my take on that one. Let's talk about, we can look at Qs relative to IWM, sort of hovering sideways in here. I like that this didn't accelerate, but again, let's be mindful of the threat of a lower high. I'd prefer to see sideways activity and possibly an uptick to make it into this high. That would sort of suggest that the technology sector is going to retain leadership, which is typically more healthy, and characteristic of a bull market. Let's jump on over to the dollar, which has gotten a little bit of an uptick off of these lows. This is a really long-standing balance. I can't reinforce this enough that we've been talking about this for a long time, this general range. So 101 is a pretty key level. If we get under 101 on the dollar, which might be the result of some rate cuts here, it starts to open up upside pressure for the S&P, and that, of course, maybe has some inflationary indications tied to it. We'll take that one in stride. But for now, we're fine out of the dollar. No crazy indications there. Gold is pretty stable, all set on the GLD. 10-year, let's take a look. A little bit of an uptick into the end of last week, which is fine. I would say that we really want to watch to see how the 10-year reacts to the information on the labor reports this upcoming week. What we should be thinking about, and this is the current market paradigm, we'll talk about this as we sort of navigate some fundamental charts. Here's the inverted ZT 2-year, basically at the lows, still indicating we're still on track for a 25 basis point cut. Speaking of, as we start to transition into fundamentals, here is the tracker tool from the Fed. Still have about 70% odds of the 25 basis point rate cut, and what I was getting at before I sort of got us to this screen was just that we still want good news to be good news. We're in a current environment where to avoid the recession, to avoid the hard landing, to achieve, rather, if we want to put the positive spin on, to achieve the soft landing, we want to see strong labor data. Jerome Powell very explicitly said at Jackson Hole that the labor market has cooled and they do not welcome further cooling in the labor market. right? That they do not want to see weak reads out of non-farm. They don't want to see an uptick in unemployment. They don't want to see continuous claims grinding higher, right? So we're watching that very closely. And if they do see it grind higher, they're going to respond accordingly, right? And they're probably going to go for something that's a bit more aggressive. And that's where I think the market gets panicked. So bad news out of the labor report this week probably signals some sort of double cut probability increasing. And that, of course, starts to suggest panic button from the Fed. We want a slow cutting cycle, not a fast cutting cycle, if we're going to remain generally bullish about the broad market retaining some of these gains and continuing to push into blue sky territories. So let's take a look through what we got last week and then what we have this upcoming week. Let's go back and take a look here. So GDP, absolutely knockout read on the Thursday session. The forecast was at 2.8. Atlanta Fed's GDP nowcast was at a 2%. Talk about a gaffe from the Atlanta Fed. But 3%, that's not even close to indicating a recession. Pretty strong number there. More importantly, though, the initial jobless claims came out in line with the expectations. You're not seeing a continued acceleration out of this. Remember, this was acceleration, and the market got sort of nervous around these releases. Now, as the market's pulled back, or I should say this indication has pulled back, jobless claims have pulled back and stabilized, that's okay. That's a decent thing for the market to look for. And speaking of, let's just get into it now, initial jobless claims, this chart, I sort of shared this on X, Twitter, it shows the continuous claims and initial claims. So you've got blue continued, red initial, and it shows them compared to a year ago. I want to be very clear that every single time, let's jump into these recession indications, this thing really accelerates in the upward direction. Accelerates. It doesn't matter whether or not you're coming from negative and going positive, whether or not you've been sort of at the zero line and then accelerate. If we walk into the future a little bit here, you can see in this case, positive already and then accelerate, right? It doesn't matter where you're coming from. Generally, the continued claims need to increase because what continued claims, and this is again annualized compared to a year ago, what that would indicate is just that people are not getting jobs. They are losing jobs and not getting jobs. So again, you could probably use some sort of combination as well with the unemployment rate versus the NFP, the added jobs to the market, right, labor market. But what do we see here? Remember that the blue line is the continued claims. We've already sort of worked out the base effects from what we had prior and the sickness and how that threw off and went negative here. So we're pretty much at parity walking forward, right? We're not comparing to blown out reads. Continuing claims are moving in the downward direction. Is that characteristic of what we just saw headed into a recession? The answer is no, right? Obviously. And I think that the market's perception and just the news cycle is like, oh my God, panic, right? But if you actually look at some of these things that matter, this would be supportive of no recession. This would be supportive of everything's kind of okay, right? As long as this continues to sort of work its way towards zero and not really accelerate, we'll see if this does uptick this upcoming week. But even continued claims look sort of okay in this zone. So overall, I'm not seeing the argument for like, hey, let's buckle up. A recession is like knocking at our doorstep. And this was an additional chart that we don't typically look at. We'll look at another one for jobless claims, the unemployment rate rather, which includes the SOM rule, right? And it triggered the last sequence, right? We finally got that move up and over the 50% mark down here. You can see that the moving averages have also crossed. This is a 12-month versus a 24-month, so a year versus 2 years. You can see that unemployment is accelerating. We're not trying to like hide that by any stretch of the imagination, but where are we accelerating from? What else does the data say? Is this just a renormalization of the jobs market? It seems like it might be possible. I don't want to be blind to the fact that yes, once the cat's out of the bag, it's very difficult to put back in, meaning that this could accelerate very easily. It's very possible that a recession could come around the corner. But based on the indications I'm seeing, not only in the price action, but also that continued versus initial jobless claims that we were just looking at, as I've said already, I don't think it's knocking on our doorstep. I'm not seeing the complete and formed argument that, oh my God, things are going to get gnarly, right? So that was last week. And if we just close this up, we got PCE as well. PCE, of course, being the Fed's preferred gauge of inflation. And I do want to check in real quick. I don't know if this chart is pulled up. Yes, it is. Here we go. So contributions to the PCE year over year. What I'm trying to illustrate here is the housing and utilities in green, and just looking at it as a visual relative to pre-sickness, right? This is not a mathematical calculation, but obviously we can see it's much more of a contribution, and it's still keeping services sides of inflation higher. Now, if we want to get mathematical, and we saw this out of the CPI earlier on in the month, we can take a look at the detailed breakdown, which, by the way, we are looking at the correct table now on Friday when it was released in the pre-market show, all over the place. We did not have the correct data there. This is the correct data. So PCE month over month, 0.2. As we scroll down, what we really want to focus on is housing and utilities right here. Notice that just like the CPI, basically it's the exact same from a 0.2 to a 0.4. And my concern here is that if we do get weak labor market reports this upcoming week, and the market starts to think that Jerome Powell is going to do what I think would be a massive policy misstep by cutting double, right, a 50 basis point cut, I'm concerned that housing inflation comes roaring back, and now we have a very sloppy and ugly situation on our hands with the labor market deteriorating and inflation coming back after a 50 basis point cut. It's very difficult for the market, I should say, to digest the reality that to deal with resurging inflation, more rate hikes are back on the table. We just got cuts. What are you talking about, rate hikes, right? That is going to be the hardest pill to swallow for the market. That is probably where we start saying, okay, is there a monthly downtrend? Is there something that looks gnarly here where we could really get involved to the downside for something more severe, right? So that's my general consensus on the economic state of the market right now as we take a look at the upcoming week. Just to give you the dates and times, on Tuesday, we get ISM PMIs from manufacturing side. That's 10 a.m. Not really concerned about that one. JOLTS will be market moving. That's 10 o'clock on Wednesday. As we move forward, Beige Book is also going to be interesting just to see what the Fed speakers themselves are really seeing in their jurisdictions. And then on Thursday, this is where the rubber starts to hit the road. ADP non-farm preview, initial jobless claims versus continuing claims. ISM services PMI, is services inflation slowing down? What's the difference between new orders versus prices paid? And then down here, this is the full Monty on Friday, hourly earnings, non-farm payroll, and the unemployment rate, with Williams and Waller speaking to follow it up sort of into the day's session. So it should be a fun one. And as mentioned in the introduction, if you're looking for volatility, I think this is going to be the week, if any, as the market's really trying to digest and come to terms with the recession sort of thesis. Here's the earnings calendar. There's obviously nothing on Monday because the market's closed. Labor Day, enjoy your day off. What else do we see here? I'm really nothing. Maybe Dick's or Dollar Tree to see what the state of the consumer is. So far, all the data from Walmart, Target has been okay. Lulu sort of went south, as we know. C3AI, probably not going to, if NVIDIA was no big deal, C3AI is going to get overlooked. HPE, same concept here. What else? NEO, had a decent day on Friday. I think Broadcom might be the top watch as we come into this upcoming week, just to see what's going on there, whether or not it continues to hold up well in the whole environment after Hindenburg's report on SMCI. We'll see if they have any commentary on that. Anyways, back on over to the platform, let's take a look through some more risk appetite charts. If we look at the TLT ratio to the S&P, huge downtick on that Friday session. That, of course, is important and would suggest that there is not a flight to safety. Bonds relative to themselves, a little bit of an uptick, right? As we know, interest rates moved higher. But generally speaking, this is a counter-trend uptick, minor one, in the overall context of a downtrend, and even a more mild downtrend over here. Duration risk is still fine for equities. Credit spreads doing nothing and still sustaining themselves underneath these massive panic moves even underneath the previous lows. So all set out of credit spreads, not a flight to safety there. HYG continues to just chug along in the upward direction. The only thing that's slightly divergent is the LQD. If we go on over here, corporate grade bonds pulling back a little bit into the end of last week, almost just equal lows, which is not the end of the world relative to the balance that we have over here in the SPX. I do want to actually go back to the HYG real quick. And let's go up to daily charts. There's still line charts, but these are daily charts now. And what I'm pointing out is, you can use this yellow line as just like a gauge and a guide to see where we're at. But this has been massively divergent up until about here. And the fact that we're finally playing catch up out of high yield junk, to me, once again, is more of an indication in the grander scheme of things. This probably aligns more so with the monthly, right? That risk appetite's strong. The monthly charts look okay. If there were larger fears of recession and people defaulting on loans, why in the world would there be an influx and a positive divergence here out of junk bonds? That would be like the last place you would want to be, right? So that makes sense to me as continuing to act as a bullish pressure. If we look at Bitcoin, not really doing anything. It's not very impressive off of that 61K bottom end of the range. So really being patient there. Total breadth still improving. What a monster move out of the SPX A50 and 200 Rs here. These, of course, relate to the stocks in the S&P 500 trading over the 50 SMA or 200 SMA. Blue is 50, green is 200. Upticks last week. Mild downtick relative to the previous week out of new highs versus lows on the NYSE, but still elevated off of zero, not even close to getting negative as we've just been balancing in the range. So all set, not seeing any issues from breadth. You could reinforce this with the RSP. If the market was concerned about larger downdrafts, why would we want to be anywhere other than the most concentrated heavyweight components that are possibly going to hold up the best through a recession just because the balance sheets that these companies have? I mean, RSP, new highs, new all-time highs on the Friday session, new closing all-time highs. Very impressive stuff. Breadth is not contracting by any stretch. This is kind of what we've been looking for and we're waiting for as the market really rebounded off of the April pullback, right? So that's that. Let's jump along to the QQQE. A little bit divergent in the sense that the QQQE has much more of an equal high versus the weighted, has a little bit more room to go. So if this breaks out, that would be helpful. That would be a bull case for the NASDAQ getting in gear and playing nicely with its counterpart, the S&P 500. Let's move into volatility. It's starting to suggest maybe some sort of flush and more mean reversion back down underneath 15. Watching out for that. I'm not convinced that that'll be the case this week with the labor data that we're scheduled to release. VVIX still, relatively high compared to its base down towards 75. And if we take a look at the vol futures, you can see nice contango here over the zero line contango into the end of the week. So NVIDIA earnings on Wednesday sort of shot this thing higher out of the one day. But as soon as that volatility came out of the market, as soon as the report was released, back underneath 1275. So not overly concerned. I'll be watching this closely. If on the labor data we start getting over 1275, I would just at least, start managing expectations S&P wise and possibly even look to the NASDAQ for those shorts if this is elevated in here over 1275, possibly threatening a break over 2145. With that said, let's jump on in to the core list of companies. Let's keep this show moving right along and get you on your way enjoying the long weekend. So Microsoft is up first on the chopping block. You can clearly see the opportunity for a possible higher low. This has been a sloppy move. This has been a very sloppy move, namely into the end of last week. But I do like the hold on Wednesday of the 200 SMA and this 408.75 level. If we go on down to, so now that we understand, right, daily is searching for this higher low. Please don't misunderstand. This is absolutely a weekly lower high. But if in the immediate term we're trying to navigate back into the equal high, we need to use the hourly to start to suggest how that might take place. Any consolidation underneath 417, not so helpful. If we can get over 417, this starts to look good, and this would be the trade I look to execute on, some sort of higher low Brigade bolt over 419.85, these highs from the Thursday session, trading into 425.25. Beyond that, there's a little bit more room to run for a retest of the daily 50 SMA at 432.15. So that would be the bullish sequence. Get me here. This is then the trade, and then we'll watch to see if we can get a follow through here from something like the daily perspective. If it's going to remain bearish and just sort of like nothing to do, bearish here, and then possibly looking for this trade from point A, here's a dot, to point B, here's a dot. 408.75 failing underneath the daily breakout point down to $400.75. Let's move along to Apple and see what's going on. Daily chart first. A little bit of a weak breakout, I would say, of this very long-standing balance range. You'll see the upper wick, of course, coming back in. So it's almost a no man's land. I do not like Apple in between these two levels at 227.75 and 230.15. If we take a look at the hourly chart, we can start to see this quite clearly. I think that you chop around in here. This, get me long, and I'm looking for A to B up here. 230.15, 233 targets. Beyond that, we have 236.50. If it's going to be bearish, maybe some sort of lower high in here gives you a look above and fail, and we could target the bottom end of the range here at 222.50. I'm not completely sold on that idea, though. There was a number of failed breakouts. 1, 2, 3, right? If it comes in again for a fourth time, the argument could really go both ways, but just speaking personally, and really I can't suggest many things outside of what I would do in my viewpoint of the chart, I don't want to be short here. I really don't want to be short here. I would want to see some sort of larger failure of the balance, something that looks like this. And underneath 222.50 gets me bearish. Failure of the 50 SMA, I would entertain more bearish opportunities, probably for a retest of something like 214 over time. So we're just not there yet. I'm not there yet out of Apple. I don't want to get caught up in like a grindy move through this balance, right? Next up is NVIDIA, the one stock to rule them all. How are we doing post earnings? We're doing all right. Not too bad. So the issue with this chart is that you need to respect the battle of the time frames. You've got a huge monster daily and weekly level here at 118. But yet the daily has broken down from this flag, and you've got a more minor level as possible resistance, which did reject on Thursday, up against 124. So two viewpoints. If you're a bull here, and this is, you're trying to spot that higher low, you probably need acceptance back over 124 to get something back to the top of the range, and then an equal high breakout would seem imminent at that point, over 129.50 into 135.75. That would be the bull watch here. For the bears, I would say you want to look for this inside bar to resolve lower pretty soon, early on in the coming weeks worth of trade. So if I go on down to the hourly, it's obviously just an inside bar. This is possibly a trade just for anybody who's trying to be quick draw McGraw. That's a trade, 121.45 into 124. Thin structure. There's nothing there. There's nothing here. There's nothing here, right? So that's a trade long A to B, and then reevaluating strongly at B, right? The overhead supply possibly weighing on things. That's an issue. But the bears, right? If they're looking for a stronger breakdown out of the gates, I would just want to see like an inside bar. You could call this like a bearish 3-bar play. It's not really clean, but underneath these two equal lows, lower high in this zone. It could be arbitrary in the orange zone. Then look left. Again, thin structure. I would want to see that sooner rather than later for a retest of 111.50. I believe if NVIDIA really just starts chopping around in here and gets tangled up, it's going to lead to higher over time. That's my personal belief. Just because the earnings numbers really weren't all that bad, we can see growth is slowing down. It's not like they're putting up huge numbers anymore. They're getting a little bit fundamental, techno-fundamental in here with the opinion piece, if you will. But those are the levels. Those are the numbers, and that's what I would be watching for. For the bulls to really have something going, I would want to see, like, sure, get me the A to B trade quickly, but then also get me inside of this range. Show me the acceptance over 124. Next up, Google. What do we have out of the Goog? Let's go to a daily chart first, actually. Failure, right? Look above and fail on the outstanding range. This is outstanding because, my goodness, the broad market S&P, the NASDAQ, went from low basically back to highs in the blink of an eye. What did Google do? Absolutely nothing. All of these bars were inside of the August 5th sort of panic. Not even, sorry. Where's August? Yeah, it is August 5th. I was looking at this 8.5. It looks like it's skewed over here. Anyways, no need to get on a tangent about Thinkorswim and sort of the projections, but this lower high back inside of range, this consolidation straight to the bottom, send it to the 200 SMA, retest 156.50. I think that's pretty straightforward here. On the hourly time frame chart, now we can zoom in now that we understand that context. You could certainly consider this some sort of double top. You could call it a descending triangle. You could call it whatever the heck you want to call it. But any sustained lower highs here, the risk reward short looks something like that, and then just continued equal low breakdowns here. Risk reward short does this, 161.50. Here we go. Something that looks like that. 156.50 is the target bottom end of the daily range, right? If it's going to be bullish, you've got to get me here and I'm neutral, then maybe some sort of breakout over 166.50 becomes constructive. Next up, Amazon, Nancy, how are we doing over here? Really strong move on Friday. A little bit disappointed that it happened so late in the day. This was actually the top watch of Friday for me in the morning session. Anyways, it is what it is. Last week was, I'm not going to lie, just kind of an annoying week, if anything. We'll see if we get some more volatility and early morning moves this upcoming week with the catalysts. But generally, bullish, huge move to the upside, engulfing not really the prior days, but 1, 2, maybe like 3 days of bearish pressure to the downside. If we look at the hourly time frame chart, now that we understand that sort of retracement, I like the daily, right? This is a daily Brigade bolt, basically. I like that this is possibly an intraday inverted head and shoulders over the neckline. Again, we were watching for this move, but it just took all day, and then the afternoon really went. So anyways, neither here nor there. Going forward, this has to hold 176, right? The neckline of the original. You could call this a Man Ray pattern or something of the sorts, but pullbacks want to hold that. We want to hold the intraday high of that bullish consolidation, because what that would do is it, first of all, puts all of the shorts offsides from down here, but it also keeps these buyers happy. And then you start to whittle away slowly. Anybody who's short from up here squeezing out, you get new money longs involved if you can respect a higher low pullback, and you start a new stair-step sequence in the upward direction. So 176 pullbacks are the best. I would say that it's okay if you were to test 174, because hopefully some of these longs would hold on. But 174 is an absolute line in the sand. You've got to stay above that if this bullish sentiment is going to continue back into the highs here, equal high, and then possibly breakout for some sort of move over the daily 50 SMA. There's some room to run up here that's really coming from this more volatile breakdown from earnings, right? So this move there, that range, that's going to be, when and if we can get up there, that's going to be something worth trading for, right? 181.40 into 189.50. Next up, Metaverse, Zuckerberg's Fantasyland. What do we see? Bearish consolidation underneath the overhead consolidation. Reminds me of what we were talking about on the NASDAQ. Some indecisive doji activity in here. Generally speaking, this was a strong move. So the fact that you're not getting a full retracement into the 50 SMA, or sort of the origin of the acceleration here, to me is more bullish than bearish. And walking forward, I would really just harp on this 524.25 level. If we now go down to the hourly, we can see this, right? If this is going to turn into like a really drawn out inverted head and shoulders, crack the neckline and you're off to the races to the top end of the balance, right? Now all of a sudden, look below and fail as a question comes into mind. Target is always the top end of the range. 542.50. Beyond that, it's blue sky territories. If you're just chopping around inside of this zone, I would sort of let it be. I would start to be a little bit more constructive on downside trades if there were a lower high underneath 517.25. So a lower high here. You can test this, that's fine, and maybe this low axis support, whatever. But this is really the more attractive spot to try the short for this into 503.50. I can't tell if I just did a tongue twister there and was referencing longs, but this drawn on the screen is what I'm actually referencing, right? Anyways, that's the metaverse. Teslaverse, what's going on with Tessie? Oh, Mr. Musk, how are we doing? Again, a kind of pretty grindy move in here. 210, a little sloppy with 211 from earlier on in the week. I think 215.25 is worth respecting from the original gap down range over here. So, maybe on the daily, people are trying to aim for some sort of inverted head and shoulders. It's sloppy, but maybe there. Let's bring it on down to the hourly. Let's get more nuanced and see exactly what the pathing might come in as. Bullish, this is like, I wouldn't even call it bullish. Let me take that back. Neutral consolidation over 210, under 215.25. Brigade bolt above, and maybe you recapture multi-day highs in here, and that becomes interesting for a thin structure retracement closer to the 220.65. So again, these are trades in these choppier ranges off to our left. This is not a huge momentum style move. Maybe in hindsight, you could look at it through the lens of like maybe a double bottom there. You could call it an ascending triangle, whatever the heck you want to call it. 215.25, 220.65 would be like sort of the top watch. If we drift into this zone down here, starts to get a little bit hairy, if you will, around 202.75. Just remembering that, this 200 SMA, decent reaction, breakout level. I don't know that I would want to be short up against that, especially noting that the target, as we recall the daily chart, it's this big block of price acceptance underneath us. So I'm not loving the Tesla shorts in the grander scheme of things. Don't get me wrong. Again, you could trade this stuff. That's fine. You could trade for something that maybe does this. That's fine. But I wouldn't overstay my welcome if you use these videos from more of a swing perspective. Next up, JP Morgan, rinse and repeat of the XLF. What an absolute monster move. New all-time highs. Beautiful holds intraday. I shouldn't even call it beautiful, actually. It was annoying and sloppy. Huge downdraft, bouncing right back off of it on the Thursday session. Anyways, nothing bearish to say about the chart. Ideally, the next hold is over this breakout point at 223.25. And a shout out to the chat in the pre-market prep, of course, because GS also looks pretty darn good. Goldman, right? The reason Goldman looks good is because you have these equal highs to interact with. If it needs a breakout level, right, you're probably looking for that acceleration over 512.50. If you could get that, great. And I would sort of start to lean into Goldman, which the price is right. The options are a little bit spready, so please be mindful of that. Even JP Morgan gets a little bit spready. But generally, this structure is a little bit more clean, and you might not feel like you're just chasing it into blue sky territories, right? You have some reference points nearby, so that's Goldman. Next up, let's go on over to Netflix. Here we go. Just a balance range like the broad market. Brigade bolts over 703.50 or under 679.25, right? As long as you're over 685, I would maintain probably a bit more of a bullish stance here, noting that this bear flag failed, shorts got pinched out, and that'll continue to be the case as long as you're over that number. Next up, we've got AMD. Then we've got one more trade idea for you, and then you're on your way. Let's go to a daily here out of AMD, just so we can see it. Grind to the downside, ugly underneath this level in here, 150.75. AMD's been a tough trader recently. I think. If you guys are having a good time with it, then be my guest, but just relative to like some of the moves in here, it's not been abundantly clear as to, these ranges are just like, you're not getting the follow through, I think is what I'm getting at. Look at this, choppy, nothing, like unless you got in instantly on the open, which is typically not how the strategy works for us at least, it's just grinder all day, nothing, right? So really being patient out of AMD, trying to look for a cleaner setup. The daily is sloppy down here. Notice that you have two equal lows, pretty precise, just an inside bar. The market's more so of a balance down here. I would start to think about longs, better longs, at least over 150.75, or better shorts, honestly, underneath, like not even just the 145, the 143, right? Get underneath that, and maybe there's a better opportunity to trade this range. Oops, we want this range in the downward direction, right? 143, 136 as a possible target. So that's what I've got in the core list of companies. Let's jump on into the only trade idea I have for you, which is related to the semiconductors. Any guesses before we go? 3, 2, 1, Marvel. MRVL is the ticker on Marvel Technology, semiconductors, designing chips, whole 9 yards. Now, this chart's cool because it technically gaps up and it fades for a good chunk of the morning, but into the afternoon, where does it close? It closes over this breakout point. So I'm a believer that this could be an early week trade under very specific conditions. So the daily has mostly gone for a gap fill reversal, meaning it's finding support over the previous pivot high. That's bullish, right? Obviously on the bar to bar count, massive higher high, massive higher low, with a close over this previous pivot as well. So as we bring it on down to the hourly now, you can see this right here's that shelf. As we bring it to the hourly, sellers sort of did their thing, or you could even call it profit taking, whatever you want to call it, right? Fine, downside move, but look at this consolidation. So if we can hold up over 75.50 and get a possible pinch up and over these highs at maybe something like $1 higher, 76.50. Let's go round numbers only up here in the penthouse. There we go. If we can get this, I think that's a trade all day long. Early morning, like Tuesday, if Wednesday wants to cooperate as well and maybe set something like this on Tuesday, Wednesday comes in. Look at the thin structure retracement. That's really what I'm after here out of Marvel, to see if we can get something that looks like this intraday on something like a 5 or 15 minute chart as risk reward. So I like that out of Marvel. I like the fact that it gapped up, it faded and closed strong relative to NVIDIA, which of course moved lower, AMD, which moved lower, right? So I like that out of this particular name. And that's really it. It was slim pickings outside of this particular chart setup and everything we've already talked about in the core list of companies. So I'll leave you on that note. Hopefully you guys have great plans for this it is the short weekend, right? Or the long weekend right now. And you're out there having yourself a good time. We will be live on Tuesday morning, probably not on Monday morning. No reason to be live if the market's going to be closed there. Who knows? Maybe we'll check in on the Discord and do some chart scans or something like that. Not that there's much to look at, but I appreciate you coming out to the show. If you made it to the end, thank you for coming out. Make sure you hit that thumbs up button and you're subscribed in the whole 9 yards. We wish you a relaxing long weekend, and let's prepare for a pre-market prep, 8 o'clock as usual on the Tuesday session. We'll see you there. Have a green trading week, and I will see you in the next one.